Let's talk to Craig Erlam. He's a senior market analyst at Oanda. Very good morning to you, young Craig.
Good morning.
Right, well done for getting in today. Let's talk dollar yen. You've sent a daily chart. Lots going on with the dollar. We had a previous guest suggesting the dollar index was basically trying to break up and out. What's going on with dollar yen?
I'm inclined to agree with that in the shorter term, to be perfectly honest. What we've seen in the dollar for quite some time now, we had a little bit of a break, but for quite some time, it's been really dragged lower, and it's not necessarily due to its underlying weakness. It's more due to the fact that other currencies are playing catch-up from the last few years. And it seems right now that no matter how hawkish the Fed is, how good the data is, what the fiscal policy is, the dollar keeps moving lower. So that says a lot about what kind of market we're in right now. So any corrections that we are seeing in the dollar seem to be quite weak and short-lived. So there may be a little bit of a short-term boost in the dollar, but I don't expect it to last very long. And that's one of the things that's really captured on the chart here. You can see that we've had this now strong sell-off since the start of the year from around 114. We finally broke through 108, which is a level which we've highlighted on previous videos. And we came back to around 105.50. We're seeing a little bit of correction now into the 107s. There's two levels which really stand out to me here, or two zones, as I say. There's that 38.250 fib, just marking the retracement from the recent high to the recent low.
Okay.
The fibs, again, all they do is they mark possible retracement points. So that's if you're bearish, and these are levels which the market may rotate lower after, following a brief correction. The fact that they coincide with all of these previous lows is what makes them so interesting for me. I would like to see a bigger correction because I think the dollar sell-off has been overdone, and I think if we could see a move back towards the kind of 110 levels, I think that would be far more interesting. Again, you can see that this is a notable point for quite a long time. It would then take us back to the Ichimoku cloud, which again, all it is a bullish-bearish signal. If it's below the cloud, the market's bearish. If it's above, the market's bullish. And the cloud itself can act as support and resistance, as we've seen consolidation throughout this period, but previously when we've seen more of a trend, you can see it happening. But even recently, you can see points where it was acting as support before this very aggressive break lower. So if we get back towards the 110s, then we're looking at prior zones of support and resistance. You've got the moving average cluster there, the red and the purple lines, which are coming in at around the same area, and the cloud. But it would also mark a bigger correction in the dollar. So as your previous guest alluded to, should we see that in the dollar, then that's the level which I'd really be interested in seeing. But right now, the early test is these 107s, 108s. So again, price support, small retracement from the recent highs, lows. And at the moment, it is struggling around these levels. I think there's a number of fundamental factors contributing to that as well.
Okay, so in terms of the Feds last night, okay, we're in an environment of rising interest rates. Is it clearer for the market how many basic hikes we're going to have this year?
The market seems to be very much in line with what the Fed has said. The Fed has alluded to 3 rate hikes this year. Some have suggested it could even be a 4th, particularly given the tax reform that we had from Donald Trump earlier last year. That's a stimulatory reform, which typically would be associated with more interest rate hikes because of an expanding economy and higher inflation as a result. There's comments which we had last night from the new Fed chair, Jerome Powell, or yesterday afternoon, were quite hawkish, again alluding to pretty much more of the same thing, talking about strong economic growth, previous headwinds now being tailwinds for the economy, and so on and so forth, the inflation moving gradually back towards target as they anticipated, referring to past drags as transitory, confirming what their expectations were. So it was quite a hawkish sentiment really from Jerome Powell, but once again, as you can see on the chart, we didn't exactly see that big boost in the dollar that necessarily reflects that. So that's what makes me wonder whether we can get back to those 110s or whether this 107, 108 is going to be proved to be a resistance level for this pair. In this case, it was also not helped overnight by the fact that the Bank of Japan bought slightly fewer long-dated bonds as part of their QE program. It was around 10 billion. Obviously, that sounds like a lot of money, but in reality, compared to their program, it's very small. And they did it early January, and they explained that by saying, this isn't a sign that we're taking our foot off the gas per se, which is what the market keeps reading it as. This is just a case of we don't need to buy them, and we'll continue to stagger this buying over a longer period of time. But the market is very sensitive to that, particularly when you're going against a currency that's fundamentally weak in the market's eyes. So I think a lot of fundamental factors at the moment are going to keep it volatile. The interesting thing is, though, no matter how hawkish the Fed seems to be, the dollar doesn't seem to be catching on to it.
On that note, Craig, thank you very much indeed.
Thank you.